Hey everyone, welcome back to Corporate Decoder, the place where we break down the financial secrets of the biggest companies. And today it looks like we've got a real gem from New York Life Investments Funds Trust, a report that might just make you scratch your head or maybe even raise an eyebrow or two in the world of MLP funds. Now, before we dive deep into the numbers, if you're all about getting the unfiltered truth behind corporate filings, make sure you hit that subscribe button and ring the bell. And hey, if you want to chat about these findings and connect with other finance enthusiasts, join our Discord community. It's linked right down below. Alright, let's get into this formal report from New York Life Investments Funds Trust. This document is essentially their semi-annual shareholder report, giving us a look at how their NYL Cushing MLP Premier Fund has been doing. We're looking at the period that ended May 31, 2025. Think of it as a mid-year financial checkup for this specific fund. First up, let's talk about the costs. For a hypothetical $10,000 investment in their Class A shares, the cost over these 6 months was about $71. That's a pretty small chunk, around 1.47% of your investment when annualized. Now for Class C shares, that cost jumps a bit to $106, which comes out to $200, which comes out to 2.21% annualized. It shows how those different share classes can really change the price you pay just to own the fund. Now for the performance numbers, and this is where things get really interesting. Looking at the Class A shares, the performance is shown including sales charges. For the 6 months, they saw a drop of 11.57%. On the flip side, for the 1 year up to May 31st, those same Class A shares delivered a solid 15.90% return. And if we look at the 5-year stretch, that's a respectable 20.29%. Now compare that to the much longer 10-year period, and the average annual return dropped significantly to just 3.42%. This tells a story of some pretty volatile times for this investment. How does this stack up against the broader market? Well, the Russell 3000 index, which is a good way to gauge the overall US stock market, had a 6-month return of negative 2.44%. Over 1 year, it was 13.2%, and over 5 years, it was 12.21%. So for the shorter term, the fund's Class A shares, even with sales charges, did better than the broad market on a 1-year basis. But over the longer 10-year period, the Russell 3000 really pulled ahead compared to Class A shares. Even with sales charges, did better than the broad market on a 1-year basis. But over the longer 10-year period, the Russell 3000 really pulled ahead compared to Class A shares. Then we have the Alerian Midstream Energy Select Index, which is a benchmark for energy infrastructure companies. If you invested in this index, you'd have seen a negative 2.806% over 1 year and 25.12% over 5 years. This energy index has clearly been performing much better than the broad market over the last few years. And this Cushing MLP Premier Tiered Index, which has a tiered approach using the Alerian MLP Index before late 2020, and then the Alerian Midstream Energy Select Index after that, showed a similar trend to the Alerian Midstream Select Index with a negative 2.80% over 10 years. It seems the energy sector, especially MLPs, has had some big ups and downs, and Clove has had some big ups and downs. Let's look at the fund's overall size. The total net assets are a hefty $1,495,532. That's over a trait $32. That's over $1 billion. And they hold about 29 investments. The portfolio turnover rate is 12%, meaning they are buying and selling about 12% of their holdings each year. This isn't super high, suggesting a more buy and hold strategy rather than active trading. Now let's see where all that money is actually invested. The top holding is Energy Transfer LP, making up 9.1% of the fund. That's a pretty concentrated bet on a single company. Then we have Cheniere Energy at 7.8%, 10K at 7.7%, and Targa Resources at 7.4%. The top 10 holdings alone make up a significant portion of the fund, showing a clear focus on a few key players in the MLP space. Looking at the industries, a big chunk, 40.6%, is in large cap diversified corporations, but then there's a substantial 19.5% in large cap ML plays and 18.2% in natural gas gatherers and processors. This really underscores the fund's core strategy, channeling money into the energy infrastructure and midstream sector, especially through master limited partnerships and Wajimit partnerships. Let's drill down into the actual holdings, because this is where we see the raw data. You can see here under the portfolio of investments, the specific companies they're invested in. For example, Enbridge Inc. holds 300,000 shares valued at nearly $14 million, and TC Energy Corp has 1 million shares valued at over $50 million. It's a detailed breakdown showing the exact weight of each company in the fund's portfolio Even in Canada, they've got holdings like Keyera Corp with 612,000 shares worth over $18 million, showing their international reach within the midstream sector. Then there's Southbow Corp, where they hold over 1 million shares valued at about $30 million. It's helpful to see these specific investments to understand the fund's strategy in action. Interestingly, they also have a small amount, $5.5 million, in something called the NYLIUS Government Liquidity Fund. This is essentially a money market fund, a place where companies park cash for short periods. It's common for funds to hold some cash equivalent. Now let's look at the statement of assets and liabilities. This gives us a snapshot of everything the fund owns and owes. Their total managed assets are over $1 billion, specifically $1,075,824,323. On the liabilities side, things like payables for shares redeemed and other operating expenses add up to about $73 million. The net assets, which is what's left after liabilities, are $1,032. Looking at the per share data, you can see the different classes. For Class A shares, the net asset value is $11. For Class C shares, it's $8.54. And for Class I shares, it's a higher $12.00. This difference in net asset value is a direct result of the varying expenses and sales charges associated with each class. The statement of operations tells us how the fund made and spent money during that 6-month period. They earned over $22 million in income from dividends and distributions. However, their expenses, including management fees and distribution fees, added up to nearly $8 million. This leaves them with a net investment income of about $14.5 million. But here's the big story. The real action is in realized and unrealized gains and losses. They had a net realized gain of over $44 million. That sounds good, right? But then they had a huge unrealized loss, meaning the value of their investments went down by a massive $103 million from operations. That's a significant hit. Let's look at the total investment return for Class A shares, excluding those sales charges, which was negative 6 months. This aligns with that big unrealized loss we just saw. For Class C shares, the return was even lower at negative 6.88% for the same period. On the other hand, the Class I shares, which don't have those sales charges, performed the best of the share classes with a negative 6.34%. Even though these are negative returns, it's important to see the difference that fees and charges make. Scroll net expenses, including net deferred income tax benefit, expense-X. Since the expense ratios are particularly telling, for Class A shares, the net expenses were 1.47%. Class C had much higher expenses at 2.21%, which is why their performance was also impacted. Class I shares, as expected, had the lowest expenses at 1.22%. This highlights the impact of share class structure on overall returns. In the financial highlights, we can see that for Class A shares, the net assets at the end of the period were about $388 million. For Class C, it's around $164 million. And for Class I, it's the largest at over 51 and 5 and 10 the Class I shares are the most popular, likely due to their lower fees. The report also touches on things like their code of ethics, audit committee, and other corporate governance elements. It mentions these are not applicable in specific ways, which is pretty standard legalese. But in a more interesting part, they detail the basis for approving their investment advisory agreements. This is where the board discusses why they continue to hire the fund managers and sub-advisors. They talk about performance fees and services provided. It's a pretty extensive section, likely a requirement to show they're doing their due diligence. They seem to justify the fees by comparing them to similar funds and looking at the quality of services. So what's the story here? This fund is heavily invested in the MLP and energy infrastructure space, which has clearly experienced significant volatility. While the fund managers did achieve some realized gains, those were completely overshadowed by a substantial drop in the value of their holdings. The expense ratios, especially for Class C shares, are quite high, eating into returns. The fact that Class I shares with lower expenses are the largest by net assets tells us investors a sector that can offer high yields but also comes with considerable price swings. The board seems to be comfortable with the current management and fees, but the recent performance does raise questions about the fund's ability to consistently deliver strong returns over the long term, especially when compared to broader market or even industry benchmarks. Alright, that's our breakdown of New York Life Investments funds. Trust this latest report. What's your take on these numbers, especially that big unrealized loss? Do the high fees make sense for the returns you're seeing? Let me know your thoughts in the comments below. If you found this analysis helpful, smash that like button, subscribe if you haven't already, and don't forget to join our Discord community for more deep dives and discussions. Thanks for watching, and we'll see you in the next video.